Good afternoon, traders and investors. Will back here with another one, coming to you with a Thursday market recap. Hopefully you guys had a very good day today. And in today's markets, guys, well, we ended up with a third green day in a row. Something definitely must be wrong, because this is definitely not usual for this year. What do we think we are in, 2021 or 2024? Anyways, it feels pretty good to have 3 green days in a row. And quite simply, guys, no need to overthink things. Today, we just didn't get any negative news whatsoever. Now, tomorrow, we do have a Michigan Consumer Sentiment Report coming in first thing tomorrow morning, which could impact the direction of the end of the week. However, we are looking to have a fairly strong week as a close. And quite simply, guys, it's just that in terms of uncertainty, very simple first principles, right? Is uncertainty higher at this point than it was last week? Well, objectively, no. Every single piece of news reporting that we've got this week has shown a slight relaxation in the tariff talks and narratives, and possible scenarios in which we might be able to find some deals from the Trump administration between 70 other different member countries over the course of the next 2 weeks. So today, in other words, in layman's terms, just very smooth sailing markets. Now, in today's video, guys, I have a very good one prepared for you. Number one, we're going to take a look at a few earnings reports together. Number one, we have to talk about Google, the biggest one of the day, of course. Then number two, we will talk about Pepsi Corporation and why that company was almost down 5% today. Thereafter, lastly, we will cover one that is not on this list at all, but I feel is a very attractive opportunity for long-term portfolios, and that will be Moody's Corporation. Now, I know there's a ton of other companies that we have not gone over. Special shout out to Procter & Gamble today that also was declining 4 or 5% at one point. Special shout out to Fiserv as well. I'll be covering Fiserv and probably Procter & Gamble tomorrow in the Friday video, just so we can space out the earnings reports a little bit. So today, Alphabet, Pepsi, and Moody's Corporation. Thereafter, guys, we're going to take a look at our major technical analysis rundown of our major stock market indexes, see how we stand after these 3 days of green in a row. Have we changed any trends, the topic of the video on Tuesday, or are we still trapped in very volatile ranges? Thereafter, we will do the same analysis on our big tech corporations all the way down there, because them in the after hours right now, after Google's earnings, are performing quite well. Google is up almost 5%, and Meta, another big advertising company, is also up over almost 4% right now. So we're going to cover those big tech earnings companies at the end, and I'll give you guys a very brief snapshot of some trades that I opened and closed today, but a more in-depth review of the portfolio will be done over the course of tomorrow's video to wrap it all up on a Friday session as we usually do. So it should be a very fun one, guys. Let's jump right into it, shall we? So the SPY up about 2.1%, the Qs up 2.81% today, and largely every single sector in the market was green, except for consumer defensives. Now, very logical reason why, right? Consumer defensives has been the sector that sought a lot of investment recently as people pivoted from growth to more value and defensive. But today, with a few earnings reports from Pepsi and Procter & Gamble, it showed that even some of these companies, especially the more consumer-facing ones, may not be as immune to tariffs as some people might think. However, today was a story about big tech and software as a service. Shout out as well to semiconductors because they've been coming roaring off their bottoms. Financials also had a very good day, reminding you guys that they were the first sector to officially set the weekly uptrends in motion, as we were saying yesterday in yesterday night's video. And healthcare sector overall mixed. UNH still down, one of my favorite opportunities, but the rest of the market performing well. A big player will be reporting for them tomorrow in the name of AbbVie. So we'll take a close look at that tomorrow, probably as well in the after hours. 1 day relative performance, you can see that most of the market was indeed in the green, led by technology. To the downside, unfortunately, consumer defensives had 2 weak days in a row for XLP, and the 1 week relative, well, everything at this point in time in the green, as this week, pretty much, we have not really had any red candles since the Monday session. It has only really been up from them. On the 1 month relative now, a little bit of a check-in as we approach the month ending of April, well, only consumer defensives are actually green. Stark contrast to what they've been doing in the last week of trade. And utilities as well, another more defensive sector. Energy, cyclicals, and technology are still trailing heavily to the downside at this point, as the correction is still underway, and you can argue that several sectors are still currently in bear markets. So before we get into more technicals, guys, let us dive directly into those earnings, and we're going to start off with the biggest one of the bunch in Google. So a little bit of a preface here. Google throughout this quarter, I mean, every single headline, guys, has been against Google. the Department of Justice lawsuit that is seeking to break up the company, accusing it of being a monopoly. You also have a European Commission lawsuit accusing Google of being the exact same monopoly too, trying to push to break up the company there, and several other different factors such as large language models clawing away at Google's business model, at their search revenue, etc. So now is kind of a prove me quarter for Google. Could they prove that they're the same company that people have forgotten how good they actually are? A company that's able to pump out, heavy amounts of free cash flow per year, right? And a company that's able to pump out, $60+ billion of profits per year with excess of almost $200 million in revenue. Well, I'm happy to say, guys, they are still the exact same company and no signs of slowing down just yet. And we can definitely see that from this earnings right now. So earnings for EPS on Google was a beat by 40%, 2.8% on EPS. Now, this was bolstered by a mark-to-market earnings gain that they recognized on their balance sheet. It's perfectly normal for them to actually do that. However, it is a bit of a fake EPS. I'll give you guys the actual net margins in a little bit, in a few minutes. And revenue, a nice little beat here by 1.19. Let's take a look at some of their segments, shall we? So Alphabet shares rise on stronger than expected revenue growth. Originally, they popped about 8%. They're up right now 5% in the after hours, which is literally almost in line with the expected move. The expected move into today's earnings was about 5%. So into the article right now, right? YouTube advertising revenue, 8.93 versus 8.97. That was a slight miss, but still very good. We'll take a look at that later. Thereafter, Google Cloud revenue, 12.26 versus 12.27. They missed slightly on cloud revenue, but it's still a very attractive gain. Traffic acquisition costs were also slightly higher at 13.75 versus 13.66. So missing some of the estimates to the downside and a little bit of higher expenses. Did that impact their net margins? No, because these are only two very small segments, right? Wait till you hear the larger search and other revenue. Alphabet's search and advertising units are still showing strong growth despite AI competition heating up. The overall company's revenue grew 12% year over year, higher than the 10% that Wall Street expected. That is one of the reasons the company is up as well. Overall revenue is higher. That did not miss. Only these smaller segments missed. Moving on further, overall advertising brought in $66.89 billion, up 8.5% from the year prior. That is very good. Google's search and other segment reported $50.7 billion, up 9.8% from $46 billion a year prior. Alphabet said that their AI overviews, its AI tool placed at the top of Google's search results page, now has 1.5 billion users per month, up from 1 billion in October. This is Google's response to people pivoting to large language models, such as maybe ChatGPT or other services such as Perplexity, right? Well, this is Google's when you do a Google search, right? It's going to give you a little search result generated by AI to answer your question directly. So they're including that in Google because they know that people are looking for more full, well-rounded answers rather than just search links. Everybody knows that, right? However, when we think of search, it's much more broad than just asking Google questions. If you're traveling, for example, and you want to know hotels near you, restaurants near you, you're not going to go on ChatGPT, right? You're going to go on Google Maps or on Google and just say restaurants near me and then use their maps feature, right? So search is very, very broad, well outside the only asking a question to your browser type of searches, right? Moving on further, Alphabet's net income increased 46%, which is very strong, but a lot of that was due to the one item that we'll take a look at right here. The company said that it included $8 billion in unrealized gains on its non-marketable equity securities related to Alphabet's investments in a private company. If you were to remove this $8 billion, Google's net margins still stand at 29.4% net margins, which excludes those other bets, which is very strong, guys. 29.4 is arguably better than a lot of their most recent quarters, right? They had one of those in Q1 of last year, and in Q2 as well. They had, Q3, they had 29.8. So another 29% net margin quarter for Google. This is outstanding, right? Absolutely outstanding metrics by such a big power player. The company reported revenue of $12.26 billion for its cloud computing business, which was slightly below the expectations, as we already saw. That is 28% year over year. And the margins came in at 17.8 compared to 9.4%. So as Google Cloud scales, it is getting more profitable, and you can see that by the net jump in operating margin at 17.8% versus the 9.4, almost a 2x in margins from year to year. Alphabet made its largest acquisition ever in March when it agreed to buy Wiz for $32 billion in cash. All cash deal. We'll see if that deal goes through by the end of the year, just to show you how much Google actually generates in cash per year. It's outstanding. We think this will help spur more multi-cloud computing, something our customers want, which is the reason behind the purpose of the investment rather into Wiz, which is what the CEO Sundar Pichai just said. The company said its other bets segment, which includes its self-driving car unit Waymo and life sciences unit Verily, brought in $450 million, down 9% from $495 a year earlier. The unit is still at a loss here, that other bets division, of about $1.23 billion, a drop in the ocean for Google overall. Alphabet says Waymo is providing more than 250,000 fully autonomous paid rides per week across the San Francisco, LA, Phoenix, and Austin regions. That's pretty good. 250K per week. That is up from 200,000 in February. So they are growing and they are scaling. We know that they are geo-fenced, which is all what the Tesla fans like to say, right? I'm a Tesla shareholder too, right? But you can't deny that Waymo is doing a good job with their own respective business model, right? Waymo is continuing to progress in building on its impressive technological achievements to scale rapidly and develop a sustainable business model. Talking about those net margins, right? Still operating at a loss is Waymo. Alphabet also said that its board authorized it to repurchase an additional $70 billion in shares, just as it did a year ago. This is absolutely massive, guys. Another $70 billion. That is an additional 3.5% of the entire float. So, they're burning through those buybacks and they're just continuously doing more and more and more and more. Trailing 12-month free cash flow, guys, is $74.8 billion. This quarter, $19 billion in free cash flow. Absolutely outstanding quarter for Google overall. Just goes to show company's still super strong. And I mean, I've been pretty much very vocal about buying this one. We'll get into the end. We'll get into that towards the end of the presentation, though. So here's a couple charts for you guys. Google search and other, you can see year-over-year change, 9.8%. YouTube ads was up 10.3% year over year, and Google Network was down a small 2.1%. Google search revenue, you can see that, sure, although it's not as big as last quarter, Google is somewhat cyclical, goes up through Q4, which is their best, and then Q1 is their worst, and then moves higher. So this is not too bad for a Q1. It's up in relation to Q1 of last year, that's for sure. Google YouTube and network revenue, also a very strong quarter for Google YouTube ads overall. Sure, it was down a little bit versus last quarter, but still very strong in relation to Q1 of 2024. Google Network as well, although was down overall, it's a smaller component of Google's business. Very solid though, revenue by segment. Google Cloud, there's your 28.1% change, and Google Other, 18.8% year over year. Very strong, guys. Google Other segment revenue, very, very, very strong. Really hard to pick apart Google's earnings for these. And are they doing it while increasing expenses? Well, not that much. Total revenue was up 12%, and total costs and expenses were only up by 8%. So Google having positive operating leverage, being able to scale their revenues while not incurring so much additional expenses, right? You want to see them be able to scale revenue faster than the cost of that revenue is going up, right? Well, I'm saying cost of revenue. That's not actually cost of revenue. It's total costs and expenses, but you guys know what I mean, right? Semantics at this point. Your bump in net income, of course, is from that extra $8 billion. But even without that extra $8 billion, it would be a very nice gain. There's the revenue chart and the operating income chart, which is very important. This removes the other bets gains, right? So very nice operating income boosts. And overall, the costs of revenue, although they are going up and operating expenses are going up, you can clearly tell that they're going up less fast than the cost, or rather than the revenue is scaling overall. Services revenue, right, which includes search and other, YouTube ads, and Google Networks. We went over those before. Just so you understand, subscription, platform, and devices is also included in this chart. Very strong, guys. Very strong. Like, what is bad with this report at all? Nothing really, right? Nothing is truly bad. Capital expenditures is still reiterated around $75 billion for the quarter. They said that just a few weeks ago, $75 billion in CapEx. That was reiterated. No change for this on Google on the earnings call necessarily, but they break it down quarter by quarter overall. And trailing 12 months free cash flow, I mean, here's what it is, right? Very, very strong trailing 12 months free cash flow. 18.9 this quarter, which is a 13% gain from Q1 of last year and 8% year over year bumps in free cash flow. So there's really nothing wrong with this company right now other than the sentiment surrounding the company. That's what's poor. Everybody's jumping to conclusions as if large language models are going to kill Google's business overnight. It's probably not going to happen. Do they face more competition? Yes, but we're also forgetting that this is a very strong company with a lot of money. They can adapt, and their Gemini product, guys, is actually very good when you benchmark it against Grok, when you benchmark it against DeepSeek, when you benchmark it against other platforms as well, such as OpenAI's platform and whatnot, right? Very, very, very strong, guys. Very strong. They keep playing leapfrog with the benchmarks. 3-4 weeks ago, Gemini had some of the best benchmarks in the entire game. So they are holding up their own after getting off to a rocky start last year. They're definitely holding their own, and we can see that so far there's no real negativity surrounding not only their cloud revenue growth, their search revenue growth is still up almost double digits. Advertising revenue is still doing good. Advertising revenue, I mean, keep in mind, this is Q1, right? And it does encompass February and March, which is when the worries around the tariffs started coming into play. But keep in mind, advertising on Google is somewhat sticky, right? Maybe not for large corporations in terms of hyperlink placement, right? To be top tier on Google's ranked searches. But when you're talking about a small and medium business, when I'm on Google Maps and I type in dry cleaner near me or lawyers near me, right? Those guys pay to be top of the list at that point in time. So all of the localized searches, if you're a small and medium business, you have to pay for advertising. It's the same thing if you're advertising on Instagram or TikTok or on Facebook, right? If you're a small business, you kind of need those advertisements to live. Are you going to maybe scale back on them a little bit? Yes, but you can't absolutely kill them, or you kind of kill the traffic to your business overall. So Google advertising revenue showing to be somewhat resilient, but we'll see what happens if the economy truly slows down. I think you'd only really start seeing big hits on this one in Q3 or Q4, but very nice quarter overall from Google. Now, at the current price of 168, is it a very good buy with all the positivity that we keep saying? Well, at 170 right now, it's still at a forward price to earnings ratio of 17.5. Just had to update the numbers there. 18.08 as a matter of fact, with the increase on EPS. And at 170, you're also trading at a PEG ratio of 1.21, which is very, very cheap for this company, guys. Trailing 12 months free cash flow yield is at 3.8. Usually you don't find these Mag 7 companies under, or rather above, a 3% free cash flow yield because they always trade somewhat expensive. This one is trading fairly cheap. EPS up and to the right over the next 4 years, and revenue as well up and to the right over the next 4 years. No problem there in terms of the balance sheet as well. Well, we know they're a cash flow monster, so it should be no surprise they bring in a ridiculous amount of free cash flow on a yearly basis, over $70 billion. They do still have some good cash and cash equivalents on the balance sheet, but that will most likely all be depleted when the Wiz deal goes through at the end of the year, when they can acquire that cybersecurity company. So, they're going to need to outlay about $32 billion in cash, but they have the cash to spend and not that much debt either in terms of how much free cash flow that they bring in on a yearly basis. So very strong company overall, very good valuation. I like it for a little bit of a swing trade. I've been very vocal about that down there. Even right now, guys, I mean, it's not the worst, but I'd like to see a higher low for maybe some more upside continuation there coming into resistance right now. But for a long-term portfolio, I think this is really a no-brainer. If you like Google as a company, if you've contemplated investing in Google as a company, I think the fundamentals at this point, guys, speak for themselves. Very cheap, wide moat company, not as easily disruptible as people may think, because they're also going to fight to retain a lot of that stuff, right? Now, in terms of the lawsuits, will they be able to break up the company? We will see, but there's a lot of analysis out there that might say that Google, if you split it, might actually be more expensive, more valuable between the sum of all its parts rather than looking at the whole, right? If it has to spin off the search business, the Google Chrome business, the YouTube business and whatnot, if you evaluate all of them independently, I don't have the research in front of me right here, but you can, at this point, just Google it. You'll see that most people do, under consensus right now, find that Google broken up could actually be better. So in terms of that, whether it's going to happen or not, we will have to see in terms of that final decision in roughly a month's worth of time when the lawsuit wraps up and we get to see finally some resolution to these cases. But as of right now, the company is trading relatively cheap. And of course, it's a buyback monster with those additional $70 billion in buybacks. That's everything I had for you guys in terms of Google earnings. Now let's dive into the second one, which is going to be Pepsi. So Pepsi coming down wildly today, 5%. But Pepsi has been dropping now, it seems, every single week now for pretty much the last 6-7 months in a row. From the all-time highs, Pepsi is currently down 27%. A few rare occurrences have happened on this chart. Pepsi rarely trades below its 50 monthly moving average. As you can see, it's been trading below it now for roughly the past 4 or 5 months. It has not really done that much in history since 2008 overall. Additionally, below the 200 weekly EMA, same concept, right? That one tends to follow the monthly moving average. Same thing, not since the recession, right? And even prior to that, it very rarely clips into it. So the technicals are telling us that maybe it's a good time to be acquiring some shares of Pepsi. And I've also been very vocal on this one as to this might be a very good opportunity in value. At these current prices right now, Pepsi is paying 3.81% in dividends as well. Let's take a look at their earnings and see why they dropped again. Well, Pepsi had a very rare miss on EPS, missing on EPS by a fraction, but it is still a miss and they're not usually missing. 0.9% bump on revenue as well. But look back on all these earnings, guys. Pepsi very, very rarely misses. Last time they missed was all the way back here. Also a fractional miss, but they do not usually miss. And if you go even further back in time, you'll see like they do not miss. So overall, it was a bit of a warning shot to the market, similar to what Walmart gave us about 2 months ago when they reported their own earnings, right? So let's move into Pepsi and see exactly what happened here and then derive, is it a buy? So moving into Pepsi, I'll remind you before we do, Pepsi is not just the beverage company. It has a very large food division. If you guys didn't know, their food division brings in more money than their beverage division. But I won't go through all these brands, but I'm pretty sure you guys can recognize a ton of different brands, either from the Frito-Lay division, which is their chips, or the Quaker Oats division, which is all of these fantastic brands down here. And then, of course, they have all the beverages, which does include Gatorade. That's a very large brand for them, right? So moving into Pepsi, PepsiCo cuts its earnings forecast as it predicts uncertainty in tariffs and consumer spending. They cut their guidance on EPS. And normally Pepsi is a company that through all markets is somewhat resilient because they're a veteran at this game, right? They've been through so many different markets. Usually their EPS consistently goes up, but now the projection for this year is flat EPS overall and very low single-digit revenue growth because of the macro uncertainty. There's a few other factors at play, and we'll talk about those too. But we have to pay notice to these companies. Shout out to Procter & Gamble because they went through the exact same thing today, warning about the tariffs and the impact of tariffs on consumers. Moving on to Pepsi, though, they had mixed quarterly results as its international sales offset weaker demand in North America. The food and beverage giant also cut its forecast for core constant currency EPS, citing tariffs, economic volatility, and a more cautious consumer. Everything we've been talking about for a while now. As we look ahead, we expect more volatility and uncertainty, particularly related to global trade developments, which we expect will increase our supply chain costs, said the CEO. So do tariffs increase costs? Absolutely, right? At the same time, consumer conditions in many markets remain subdued and similarly have an uncertain outlook. So here we go right here. Net income for the quarter was $1.83 billion. That is roughly, well, I put it here on the Pepsi chart. Sorry for not putting it in there. It's about 10.2%, guys, which is not terrible. It's in line with Pepsi's historical average, which range between roughly 8 and 13. So it's kind of right in the middle there. So I wouldn't say it's a disaster, right? But it is kind of in the middle, nothing fancy. Pepsi's worldwide volume fell 3% for its convenient foods unit and was flat for its drinks. Really on the food right here. LaGuardia, the CEO, said the company is taking actions to improve its North American performance. Volume for its domestic food business fell 1%, while the North American beverage unit saw a volume decline of 3%. They're going through a fundamental structural change. Because of these things that have been affecting Pepsi for roughly the last 6 months, as they've ran out of pricing power as consumers constantly search for deals. Well, now if they're dropping prices, if they do not want to cut their margins, what they have to do is find cost efficiencies. What Pepsi has been doing is consolidating their North American distribution centers and manufacturing centers into the same places. They used to split beverages and foods, right? Now they're consolidating everything to common locations in order to save costs on transportation, logistics, and some things like that. So they are doing what they can to protect those net margins, which is good. Consumers have remained value conscious across brands and channels as the cumulative impacts of inflationary pressures have strained budgets and altered food shopping patterns. We also have some other secular trends at play here. Plans to turn around its North America business include expanding further into multicultural and functional products like its Simply, Sabra, and Siete brands. The company also bought Poppy. You guys might know that, a prebiotic soda brand. If you guys don't know what Poppy is, it's very popular on social media. It's these cans right here, right? Now, wildly popular, so it just goes to show that they are trying to expand their reach to different markets and different consumer segments. This one more targeting a younger and more health-conscious consumer, if you can imagine that, and to appeal to consumers using GLP-1 drugs. Pepsi plans to add more protein to its portfolio. This is the secular trend that I'm talking about. People moving more towards health-conscious products in the future. This is something that is affecting Pepsi. Take a look down here as well. Pepsi is also accelerating its transition towards more natural ingredients on the heels of the FDA's announcing plans to phase out synthetic dyes by the end of the year. Shout out to RFK Jr. That's a very good thing, by the way. Maybe not so much for Pepsi, but very good thing for the health of the consumer overall. LaGuardia said Lay's and Tostitos will no longer use artificial colors by 2026. I think that's a very good pivot by the brand. Well, they're required to from the FDA, but they should have done this a while ago to notice this secular trend and pivot. Now, last comment, in the next couple of years, we'll have migrated all the portfolio into natural colors, or at least provide the consumer with natural color options. And obviously, every consumer will have the opportunity to choose what they prefer. Why do they use artificial colors, guys? Because the products look more pretty and they look more appetizing overall. It's really the only thing. It is a marketing gimmick. Now, obviously, at the expense of people's overall health, if the dyes are not sourced properly, right? Which is what RFK Jr. has been trying to remove from a lot of the fast food industry. So those are the secular trends working against Pepsi. Now, as you can see, the impact on them was not so good, right? Revenue down 2% year over year. EPS was down 8% year over year. Their Beverages America revenue was flat. Foods was down. Organic revenue was slightly higher. Operating income down 5% year over year. The expenses were up, so operating income down and expenses higher a little bit. Net income was down 10% year over year, but they did have a way to find free cash flow right there, which is pretty good. They're still doing share buybacks as well, as we can see right here in terms of these shares outstanding. Still doing buybacks, so at least they're trying to protect their shareholder value by paying out a very decent dividend right now, 3.8%, and doing a lot of shareholder buybacks additionally as well. Now, you can see this reiterated seasonal quarter-over-quarter declines seen across all realigned business segments. Here's your Pepsi Foods North America quarter-over-quarter change. Q1 is usually soft, as we can see right here, yeah. Q1 is the softer quarter, but still, this quarter is softer than 2024, not what you want to see. That is for foods, North American beverages, right? Same thing, right? Very flat in relation to last year. It should come back up over time, but Q1 is usually traditionally a bit weak for Pepsi in different markets. International beverages up 2.7 year over year. That saved them. EMEA down 1.8. Latin America foods down 12.1. Asia Pacific foods down 2.7. And you can see net revenue here. International, well, most of those divisions, right, are reporting weaker than at this same period in time of Q1 of 2024. That is why Pepsi is down 5%, plus their cautionary guidance. No secret there. So with all this considered, is Pepsi a good buy right now? Well, at 135 right now, they are expected to have a forward price to earnings of 16.56, which is arguably 10-year lows. You don't really find companies at 10-year lows unless they're going through some form of issues, right? Stocks just don't sell off because eventually the valuation just gets too high and people just sell it off for no reason, right? Just look at Costco, right? Unless something goes wrong with the company, that's when you usually get the best deals on these things. If we take a look at the trailing 12-month PE ratio, and I just extrapolate the forward one to a 16, you'll see here that 16.5 is lower than at all points since 2015, except for one little period right here in 2019. So Pepsi, arguably in terms of valuation, is trading very low in relation to its own history. The PEG ratio is 2.07, but when you have an EPS growth rate under 10, the PEG is not the best thing to use. Price to sales is pretty good right now at 2, and a free cash flow yield of 3.8% is also fair for this company. Couple that with the fact that we are coming into the next line of defense in terms of support areas, which will be all the way down here, roughly 135 down to roughly 127. And combined with all the previous technical indicators that we were talking about in the intro of this earnings. So is Pepsi a buy? It can be a very decent buy, guys, in terms of an addition to a long-term portfolio. If you're looking for something defensive, right? We know that Coca-Cola is a lot more expensive here than Pepsi at the all-time highs, a lot more expensive overall. And I do think Pepsi will be able to recover. These issues will not be permanent for Pepsi. It has always found a way, guys. This stock has been on the markets since the 1960s, essentially, and it has always found a way to give shareholder returns. And if you are buying it right now on a dip, 26% from its all-time highs, it stands to argue that your ROI over time can be quite interesting, especially if you factor in the dividends as well. So keep that in mind. It is a buy for me, and even for a little bit of a swing trade here, guys. Monthly, almost oversold. Well, if I take the dividends off, monthly almost oversold conditions. That has not happened, guys, since the great financial crisis. This is almost the lowest monthly RSI on Pepsi since the 1970s. So I do really think that it does deserve a second look, both for a swing trade from the support range, right, up to maybe the most recent highs, 140s, 150s, or a long-term investment. That is everything I had for you guys for Pepsi. And now the last one we're going to take a look at is going to be Moody's Corporation. So guys, Moody's Corporation has come up since their earnings. They had their earnings on Tuesday morning, and since that period of time, they're now up over 6.5% from the bottom. Now, Moody's Corporation is one of my favorite companies in the market. Warren Buffett also owns this one too. Why? It has a very high moat and a very large competitive advantage. It is one of only 3 credit rating agencies in the entire world, and they also have a very massive data analytics business, which gives them some very juicy annual recurring revenue in terms of a subscription model. That being said, Moody's has suffered, as well as the rest of the market recently, and still is down roughly 17% from its all-time highs. So is Moody's right now a buy at the 440 area, in my opinion, for either a swing trade or a long-term portfolio? Let's take a look at their earnings, shall we? Their earnings, they beat on EPS by 8.14% and beat on revenue by 2.54 as well. The one thing I do like about Moody's, though, guys, it's a very boring company. You don't really need to look at their earnings so much as you would something like an Alphabet, as you would something like a Pepsi. Moody's is kind of a very defensive corporation in that respect. It's a very boring business model, a lot of annual recurring revenues as well in that. They just have a huge moat overall with very high margins and very decent metrics in terms of free cash flow. In other words, you don't really need to think about it too much, and that's one of the things that I do like. Now, if you take a look at their earnings slides, because Moody's is so boring, it's literally so boring that people don't even write articles about it. I swear to God, you can look for Moody's earnings. Usually you'll find a CNBC article or a Bloomberg article or something like that. You go on these news and it's just giving numbers. There's no commentary. There's no nothing. Like literally, it's just so boring. Nobody even bothers to report on it. And the people that do, they're kind of hidden behind paywalls. You know what I mean? It's just so boring. Let's take a look at how boring their numbers actually are. They're doing very, very, very well. Revenue grows 8% across the board. Adjusted operating margins were up to 51.7%. That is up 1%. And EPS increased 14% year over year. MIS, their investor services division, it's either investor services, which is their credit rating agency business, or their Moody Analytics, their data analytics business, where they provide various amounts of data to financial institutions about the credit ratings of certain companies or other financial metrics that might be, potent to people's analysis of different businesses, right? Very big business for them. So MIS, their credit rating business, for the most part, achieved the highest quarterly revenue on record at 1.1 billion, and the Moody's Analytics business was up 9% as well to 3.3 billion. Very, very nice. Transactional revenue for their credit business up 8%. Operating margins was also up 1.4%. And even Moody's Analytics, I mean, recurring revenue was up 9%. Operating margins were up. So they're just very boring. Everything's just going up. They're increasing margins. Their free cash flow is still very good, right? And their balance sheet is absolutely amazing. Updating selected metrics for the full year 2025 guidance. Now, this is the one thing that they did in terms of their guidance. We'll take a look at this. The reason that the stock was a bit on the rocks after they released their earnings initially is because they gave somewhat timid guidance, because a big part of the analysis on Moody's is the debt repricing, since a lot of their business is from the investor services division, their credit rating agency, well, companies only need to get a new credit rating on their debt when their debt is due to be refinanced. And they provide us with a nice pipeline table that I'll show you soon. They have a very massive pipeline through 2028. But when rates stay high, people don't want to refinance right away. They wait for rates to come lower, then they refinance their debt, and then they need Moody services. $4.9 trillion of debt repricing through 2028. I'll show you guys that slide because it's down below there. Now, MIS, their credit rating agency, you can see nice little bump on revenue by about that 8%, more issuance, more adjusted margins, very boring overall. Moody's Analytics, 8% growth, 96% recurring revenue, and a 93% retention rate with a 30% adjusted operating margin. Just everything, guys, is it's just so boring. Like I can go through, like there's so many slides, and I commend them for putting together so many good slides, right? But overall, guys, I mean, like you can take a look at their issuance schedule in terms of the debt that they're looking to do. They go through tons of different things in terms of when you see LSD to high SD, this is low single digits to high single digits. Here's their guidance. So flat investment grade, decrease of high single digits for high yield bonds. So not many people want to reevaluate their bonds and refinance their debt. Structured finance as well, approximately 10%. Financial institutions that seek their services, decrease of low single digits. So maybe from like a 4 to a 3. They don't give us the numbers there, but I mean, very easy to understand, right? It's very simple, very solid company overall, and people need them. It's just at what speed do people need them right now? And people are kind of pushing off those refinances just a little bit. Now, here's the investor services. Here's their guidance. Why the stock initially struggled a little bit. Here was their guidance. Issuance for new credit ratings on their debt. Well, they were forecasting for an increase in the low single digit percentage range, but now they are decreasing it a little bit in the low single digit range. Revenue as well, they were forecasting an increase from mid single digits to high single digits. Now staying focused to mid single digits, 4, 5, 6%, right? Operating margin as well. This was the guidance, and it's down ever so slightly. In terms of analytics, though, revenue, no change. And that's a larger business for Moody's right now. ARR, they actually increased their guidance to the high single digit range, which is good, and no change on adjusted operating margin. So it's really, you guys can tell what I'm getting at right now, right? Data analytics, no problem. Average recurring revenue is very solid, but it's the investor services division that needs a little bit more attention overall. This was for the, the various lines of business here. We're going to skip over this one because we just said it, right? But a little bit of a reduction here in the range of free cash flow. That's the most notable thing. And also a little bit of a range of declines here in terms of adjusted EPS overall. That's another reason that Moody's was brought down ever so slightly, just because of those two factors combined, yeah? Now, if you look at something that, the last thing that I wanted to show you guys is, where is it? It's one of these charts here in terms of their pipeline. Let me just find it real quick. They have too many slides right there. Okay, here we go. The last slide for you guys. Strong refinancing needs support future issuance. Refinancing needs up to 4.4 to 4.9 trillion over the next 4 years. And here is the debt schedule here. 2025, you can see, is somewhat small, but it accelerates. As the rate cuts come more and more into play, the pipeline for that starts increasing more and more. So when you know that this is one of the things that needs to happen in the next 3 years, and Moody's has been struggling recently, and you're looking to make an investment for the next 3, 4 years, 5 years to capitalize on that debt repricing, well, possibly the argument is to make the investment now into this corporation to reap the benefits of this debt repricing pipeline as it comes into play over the next 3 to 4 years. So moving on to their valuation, right? It is a good deal right here at around $440. Well, let's have a look right here. In terms of their balance sheet is perfectly fine. They have very solid net margins overall, always ranging in the, high 20% range. And in terms of right now, in terms of the debt, they don't have that much debt in terms of revenue they bring in. They have a decent amount of free cash flow per year and a nice amount of cash on the balance sheet. So really not a bad balance sheet at all. In terms of their annual EPS increases, you can see going up and to the right over time, and also their revenue as well. Very sustainable and very solid revenue model for the company. Nothing to see there. It is a very consistent and predictable company. Now, in terms of the forward price to earnings ratio at 440, it's trading at a 32.1. It gets a higher valuation for the most part from the market, just because of how consistent and predictable the business model actually is. It's the same concept as something like a Microsoft. A lot of these companies trade traditionally rich because of how predictable their nature actually is. That gives them a PEG ratio of 2.14, a little bit high, but it's because of how high the moat is, right? It's very rare to find Moody's trading at under or around even a 25 forward price to earnings. And the free cash flow yield is 3.3%. This is very good, guys, as well. Usually, you only find Moody's trading at like a 2.5, 2.6% free cash flow yield. To find it in the threes is a fairly decent proposition overall. So in terms of a long-term portfolio, guys, is it a buy for me? Yes, absolutely. I think that this one or SPGI can possibly be a big cornerstone of a portfolio, similar to how a Visa or MasterCard can be. They're just very boring companies with very wide moats, very high barriers to entry for competition as well, great net margins, good free cash flow, and they're a business that other businesses absolutely need, right? That is the mark of a truly great company that will stand the test of time through recessions, no recessions, tariffs, no tariffs. This is a very high quality business at a very good price. I would be willing to buy it here. Matter of fact, I have been buying a little bit of Moody's down there for the long term. And overall, if we do come back down here to 410 to 374, I think that is the most fantastic area as it lines up with technical resistance, which will now be support, and also the 200 weekly EMA, which you can clearly see Moody's very, very rarely taps into. It's a great location to potentially be buying a position if this is a company that you want to be invested in for the long term. That's everything I had for you guys in terms of earnings. Hopefully you enjoyed that. Now let's dive into some charts, shall we? So taking a look at the SPY, have we changed any trends on the SPY? No, not yet, but it could very well be coming quite soon. We are almost at the high of the 90-day tariff pause day. That being said, we are almost as well in the context of brand new daily uptrends. We have just clipped into the highs right now. Not clear overall, but we are trending higher. If we break above the Monday highs, which we're already above right now, well, this is going to be an officially confirmed daily uptrend. You can argue it is right now, but it's very, very close, yeah? However, above us is resistance, 565 up to 550, and the 200-day EMA is at the top end of that resistance. We are also on the watch for a weekly trend change, guys. Higher lows are set. You give me higher highs above the highs of the 90-day tariff pause, that is officially a weekly uptrend start. And with the end of the month of April coming quite quickly, the closing status of this candle will be front and center. This is a doji candle. It's looking very good for the bulls to be able to recapture some of the damage that was done over the past 2 months. So the SPY is looking good. If we get beat down, we'll be looking for a higher low. Anything above the lows of this Monday, just looking for a higher low for possible trend expansion into that resistance zone. If we do pull back, phenomenal opportunity to either buy the dip and go for that trend change with a stop loss below the low there and take profits into here, or writing short puts under the market. On the Qs, same analysis, right? Daily uptrend, yes, but it's not so clear right now. We are working our way into resistance, 477 down to 475 overall. Clear attempt by the bulls right here. Same concept. Weekly was a downtrend. We now have a weekly higher low set into support, 450 down to 432, and looking for that weekly trend expansion. Not yet clearly above the highs of the 90-day tariff pause day. But if we do get above it, that is a confirmed weekly uptrend. Shows you that the monthly lows are set. And look at this candle, guys. Recaptured everything. Might be looking to at least recover a little bit more, and maybe a two-step recovery opportunity rather than so much a V-shaped recovery. If, however, it's not enough and we get beat back down again, we have a lot of support below us. As I said, we'd be looking for a higher low, anything above 428, looking for a daily higher low for maybe a second attempt or third or fourth, depending on which ones you measure, at breaking through this resistance area and continuing a daily uptrend pattern. Looking very good. If we come back down, that is the entry. Stop goes below there. Take profits go up here. And thereafter, you're also looking for short puts under some of the fear lows. Moving on to XLF financials. Financials, we took notice of this yesterday. This was the first sector, and I was saying, this is your lead bull. It may give us an insight into whether or not the indexes want to also continue onto daily uptrend and weekly uptrend status, because they already have it. Well, now you can see the SPY and the QQQ are following along. XLF remains your lead bull. So watch it in terms of pullbacks. If it starts pulling back, it'll probably be leading the market into a pullback, right? Daily uptrend is now clear as day. We are still in the confines of resistance, 48.34 down to 46.75. Any pullback looking for a higher low. Anything above 45, looking for that higher low for possible further daily uptrend continuation. possible further weekly uptrend continuation as well. Looking very good. Weekly uptrend means your monthly consolidation is finished. And this monthly candle close may close above the area that's been resistance for a long time that we're in right now. If we close above it by next week, guys, that'll be very nice. That'll be the bulls protecting the top end of the range they've kind of been trapped in. Well, of course, we've went lower, right? But this at this point would be monthly closes all within the same tight range, not looking too bad at all. Moving on to healthcare right now. Healthcare still struggling as your lagging sector out of all the big bunch. Very wide range right now. No clear price action, no breach above the highs, no breach below the lows either. So we'll keep monitoring this one. The clearest time frame, in my opinion, is the weekly chart. Moving on, weekly downtrend, decent sized bounce, not as good as the SPY, the Qs, or the XLF, but an okay sized bounce right now. Look to the highs of 2 weeks ago at this point. That will give you an idea if we get the weekly uptrend or not. So far, so good, protecting the 200 weekly EMA and still in the confines of this big support area. 140 down to 125 is that huge support range. XLV rarely trades below its 200 weekly moving average. When it does, it could be a good proposition, not only to buy the index, but maybe to find some of the best companies in that index who might have gotten unfairly hit from some earnings results recently, such as UNH. Oops, sorry about that. My chair kind of came undone on me. Anyways, might be one of a good buying opportunity on UNH. I'm positioned for UNH, right? It may just be a very nice opportunity. I think it still is right now for healthcare. Moving on to SMH. So semiconductors not performing too poorly today, 5.06%. And semiconductors have now done something they haven't done in a while. They are now on their way to a nice engulfing move right now. This was a bit of a confusing run, right? It was a new daily downtrend. We have since engulfed the move, but the clearest time frame, as I keep saying, was the weekly. Weekly downtrend or lows. Now you got the lower highs, the higher lows. Could we be going for a weekly trend change as well? You have to breach the highs of the tariffs. The only problem with that is it's into resistance, 215 up to 233. So don't think it's going to do this, right? If it comes up here, maybe it gets rejected. Then you maybe get one final opportunity to buy the dip, perhaps. We're going to keep our close eye on that. But one thing's for sure, at this point in time, any move lower, looking for a higher low, anything above 184, looking for that higher low for a possible further trend continuation on the daily into resistance, which would, pursue the attempt of a weekly uptrend as well. If we get a drop, no problem at all. I'll keep riding my short puts towards the fear lows on my favorite companies. You guys already know the drill. AMD, Micron, NVIDIA, TSM, companies like that are at their lows. Special shout out to companies like ASML with very wide moats and huge competitive advantages, which are equally at multi-year levels as well. Special shout out to them. I do have them in my long-term portfolio. Moving on to the IWM Russell. The Russell setting the daily uptrend in motion right now. Not looking terrible at all. Daily uptrend is nice into resistance 199. Call it 200 down to 188 roughly. That being said, big area, guys. Big support, big resistance, big support. So you know the level is important. Coming into the 200 weekly EMA soon at 197. That being said, we are also in a confirmed weekly uptrend at this point on the Russell, looking to get back a lot of this damage right there. Finally, a trend reversal pattern from our Russell. And now on the monthly, the damage is done, but might just be looking to recover a little bit and maybe go into some form of an extended two-step process recovery. Not a bad bet to be into the Russell right now. I just wouldn't be going too heavy as the economic landscape remains somewhat uncertain. And the one thing you don't want to have is FOMO with a heavy position, right? But if we're looking for a higher low, anything above 180, looking for a higher low, any retracement, stop loss goes there, take profit goes somewhere up here. That's a nice little swing trade opportunity, or to write some short puts below the market. Not too bad of an idea either, into the support range 180 down to 165, which would be these guys from all the way back there. The Dow Jones, lastly, the Dow Jones not looking too bad, 1.23% to the upside, but somewhat unclear. No trend change at all. No breach of the lows and no breach of the highs. So still a very wide and volatile range. Trapped between resistance right now, 41.3 down to 40,500. And below support, 39.1 down to 38,000 flat. So we'll be looking for the Dow to break one or either direction right now. The weekly, still in a weekly downtrend. Nice, very nice engulfing. Well, not engulfing, but, a nice 61% move to the upside. Looking additionally for the weekly higher lows to be set. Give me a breach of the 90-day tariff pause. You officially have a weekly uptrend. And similar to other industries, you will have your monthly lows officially being set. And maybe the Dow also takes a smooth but slow recovery style back to its own all-time highs. We'll pay special attention to that when it comes. The VIX down another 6.96%, now back down into the hotly congested area, which always comes up. 30 down to roughly 23 is that range. I mean, you can call it 30 to 25 or whatever metric you want to use. Just understand in times of high uncertainty, that's where the VIX can stay sticky whenever it does come up there. So I'm still a big fan of profiting from a high VIX by selling options into the market. And you guys know the drill, right? It's not over until it's over. We have less uncertainty than we did 2 weeks ago or even last week. However, it is still an uncertain market, and any headlines can catch you off guard, and you can see a volatility spike. So just keep in mind the VIX can stay sticky and can stay higher than you expect for longer than you expect as well. In terms of the dollar was also a bit weak today, which shows that, there's no big resurgence into the US dollar in terms of purchasing. But overall, we are still maintaining this breach below this range, this last 2-year range. And if we do get a bit of a rally, you have to deal with all that resistance. Will this be the scenario that plays out? Nobody knows, right? Of course, it feels a bit more comfortable now that equities and bonds are green, but you obviously see that there's not a massive inflow into the dollar just yet, as people are still somewhat a little bit skittish. Moving on to the 10-year yields and the 20-year yields, same concept. It's nice to see them come down, over the last roughly a couple days of trading, but no new levels have been gained, right? We're still nowhere close to the lows that we were before all this fear started on the 10 nor 20-year yields. This is a very complex trade overall, guys. Remains to be seen if foreign nations are going to clamor towards these yields eventually. But, it's a very uncertain environment right now. There's a lot of uncertainty around the United States, which is why these yields are commanding a higher risk premium overall, which is why you're not seeing massive amounts of people rush to buy these bonds because they want more risk premium. We'll see if the yields be maintained high, but the bonds right now finding some form of a local bottom on TLT. Seems as though that Trump put is really coming into play. I like these 20-year bonds for a bit of an upswing, but as I've said many times on the channel, guys, it's going to be a very long process of recovery whenever that recovery does start. But we do still notice that there are still some problems in the bond market as credit spreads still remain very wide in terms of their historical averages. Now, moving on to gold. Gold is actually up today and was up over the course of the day with the equities market, so kind of running counter trend, right? Gold still remains popular as an asset, but you did have a very large amount of a pullback right here into the 12 EMA. Pay special attention to your smaller time frames. As of right now, the bulls have want to recapture the hourly uptrend, but we know after such a big pullback overall, are they maybe just looking for a lower high and lower low? That is to be seen. What you need to watch for here is a loss, not only the hourly, but also you need to lose, right, the 4-hour trend in a significant fashion. So far, they have started it with a 1 day worth of pullback, but gold, it's just very tough to read even up here, guys. This move is a historic move. These moves are all historic moves. So the price action, although somewhat unclear, points to the fact that the bulls are still clearly in a weekly uptrend, but I'd be somewhat wary of buying a candle that looks like this at such extended levels on a weekly RSI. I'm a bigger fan of waiting for a pullback into the 12 EMA and then playing in a long attempt from there. But I'm also not very willing to go short all the way up here, as I know that any further headlines of uncertainty just do tend to push this asset price higher overall. And now lastly into Bitcoin. Bitcoin also looking quite good after having that record move through the resistance range. The last 2 days, Bitcoin has done absolutely nothing, but that's not a bad thing. They're kind of holding the highs. This whole range was 92 down to roughly 87,000. I cannot close this box green just yet because this candle only closes on Sunday, but we do have a couple few things. MACD on the weekly seems to be wanting to curl over right now, and the daily uptrend is clearly in the bull's favor, looking for a higher low, maybe back testing the level they just cleared as support. And then if they do choose to make one next leg higher, we are obviously going back up to the all-time highs, 100,000 to 105 flat. And the monthly trend would indeed confirm that. Just always we're looking for a monthly higher low for further trend coming perfectly into your 12 EMA. If we do see that rally, it may take a few months, but that is the overall direction. If Bitcoin is able to maintain these trends and we don't get a more fearful market environment, because we know that sometimes this asset likes to perform like a risk on asset. Sometimes it likes to perform as an inflation hedge. Sometimes it likes to perform as an actual currency, as it is right now, because the dollar is weak, Bitcoin is outperforming, gold is outperforming, etc., etc. Very complex trade overall. But one thing's for sure, I'm still going to be a Bitcoin holder for the long term, all things considered. That's everything for your market rundown. Now let's get into big tech and then we are done. So we're going to move into our tech names, and I'll do these relatively quickly because we spend a lot of time on them on the Monday and Tuesday videos and are still looking for the exact same trend changes. That being said, speaking of trend changes, look at Apple right now trying to go for it overall, and the higher lows are set right now at 190.03. We are staring at the face of resistance, 210 up to around 221 right now on Apple. Obviously, the lowering of the, or rather relaxing of the language against China has largely helped out this stock a lot. Weekly downtrend, looking for a weekly higher low for the weekly uptrend shift. That will only be a break of last week's highs. If you do see that, weekly uptrend is set in motion. Your monthly higher lows are set as well. And we'll be looking to Apple to maybe slowly recapture this monthly uptrend as the year advances if we do not experience a larger economic decline. But so far, we're going to take this one day at a time. Any move lower, well, we're just going to be looking for a higher low above 189.58. That would also be a perfect opportunity into support to maybe write some put options below the market. Moving on to AMD right now, 4.51% to the upside today, looking very good. No clear trend change, though. Still trying to go for it. Arguably equal lows, right? Arguably trapped between two ranges. Overhead resistance, 112 down to 98. And the big below support area, which is 83 down to 63. All the guys from the bottoms of 2022. That being said, AMD is going for the same thing that a lot of the charts are going for right now, a daily uptrend shift, but also a weekly uptrend shift too. This would be the first of its kind in a very, very long time for AMD overall. You would need a break of last week's highs, to get that weekly trend change in motion. That will let you know that the monthly consolidation phase is finished, and then we'll be looking for the bulls to put in a nice move in relation to all of this last 6-7 months of selling. I think a fair price target for near-term appreciation, if the market does pivot to short-term bullish, would be about a 130 or 120 up to 130, the next area of support. So there is a swing trade here on a dip, or even from here, guys, with the stop below the lows, targeting the most recent large weekly level that sent us down for this leg right there. Decent, right? Stops, take profit, not too bad of a trade overall. And of course, if we come back lower, I'll gladly sell some put options in the lower range. Moving on to Amazon right now. Amazon 3.29% to the upside, also in search of its own engulfing move into resistance right now. 191 down to 180 is Amazon. Any move lower will be a good attempt by the bulls to set a daily higher low for a possible trend change. The best case scenario is if they just clear this resistance range and then set it all the way up there, yeah? But one thing is very sure right now, they're also looking for a weekly trend change. Higher lows are set, right? Need to get a break above the tariff pause highs to get that weekly trend change in motion. If you do see that, it'll mean your monthly consolidation on Amazon is finished. Very nice back testing of the overall big level of support, 175 down to about 143. The level, I was telling everybody, it's a very decent level, both for short puts and long-term shares. We will see, do the bulls have it in them to put in a little bit of a monthly rally overall? Not looking too bad, all things considered. And the fundamentals are still, of course, fantastic. We'll go over these more in detail tomorrow. I'm going to go through these fast, though, because we've been covering them all week, right? On to Google right now. We were very clear. We just covered Google earnings earlier. But in terms of the technicals, guys, well, the technicals, tomorrow, Google will officially have a nice engulfing move. Not an uptrend just yet because they lost it right there. But now we'll have some very nice movement if we can clear this resistance range, which overall is the 175 down to 162 area. Well, we'll be well on our way to a weekly uptrend as well and put a lot of space between us and this whole resistance range. That's kind of been plaguing us since before, but very nice weekly uptrend shift at this point from Google. It joins a host of other companies that have already set their weekly uptrends. That means your monthly consolidation phase is finished, reacted perfectly into the 2021 highs, below the 26 EMA as well. It was a very nice sweet spot. So I do still like Google here for the purposes of a long-term portfolio. And even for some daily consolidation, I'll be looking to write some short put options as low as I can possibly get, while the valuation still remains cheap objectively. Moving on to Meta right now. Meta also up 2.4%, 2.5% during the day, and another 4% in the after hours, because at the end of the day, Meta is an advertising company, and Google advertising revenues were quite decent. That being said, that puts them all the way up here for the open tomorrow. Meta, unfortunately, was in a daily downtrend, now looking to have a bit of an engulfing move and recapture the lower end of support that we've been defending so well, 530 down to 450, which I brought up a few times over the course of the last 4 weeks, was saying Meta was a very good buy down here. Hopefully you guys are able to pick up just a few shares, just some nibbles, because we're not out of the woods just yet. Don't have any FOMO on any of this stuff, right? Play the levels. Speaking of the levels, resistance above stays put, 600 down to 560. They have earnings next week. We'll see if they can get a trend change underway into those earnings, or whether or not we just get rejected at resistance and stay in this very wide trading range. Moving on to Microsoft right now, up 3.45% during the day today. Microsoft coming roaring back as well. Now, they did lose the attempt at a daily uptrend with the flush. Now we got to get it back. Nice bounce. This is a roughly 78% bounce overall. So any further move lower, the bulls are going to be looking to two-step this process if they just don't V-shape it right away, yeah? The two-step process looking for higher low, anything above 355, looking for a daily higher low. For possible leg number 2 into a new daily uptrend, a pullback here would open up the door for not only a swing trade, but also possibly writing short puts again below the 360 to 350 mark. That being said, Microsoft is also going for the trend change, which would be a break of the 90-day tariff pause area. Weekly uptrend would mean that although we're coming into resistance, 393 up to 409, the monthly higher lows would be set. And Microsoft might be just looking to recapture the range of accumulation it had for the last year of trading before the tariff stuff started getting really bad. We'll get to hear from their earnings as early as next week on the Wednesday. Moving on to Netflix right now. Netflix, man, slow down, buddy. Chill out. It's not that serious, man. Really relax. I mean, I'm happy because I'm a long-term Netflix shareholder, but, you know, Netflix just outperforming the entire market right now. Year to date, guys, this one is up right now 22%. While the entire market is down year to date, this one is up 22%. So basically carrying the tech sector overall. Yeah, this is a very, very clear daily uptrend overall. The higher lows are all the way down there. Can you imagine? 900. Any slowdown on Netflix is going to be for a higher low, looking for a possible trend continuation. If you pull back too deep, you open up the doors for either a tightening range or a daily downtrend. Either of those case scenarios would just be looking for a weekly higher low. Very, very, very nice weekly engulfing move. Will probably result in a trend change overall. That being said, 987 to 955 is the biggest area of support. You can argue that, sure, we have a little bit of guys to fall back into of the previous all-time highs, but really the larger one is down there. We're pulling away fast from the EMAs, and I do not like FOMOing on stuff when they're so far away from the EMAs, so keep that in mind. But they had fantastic earnings. We covered them a few weeks ago on the channel. Now, moving into NVIDIA. NVIDIA up 3.62% today. Not too bad of a day for them either, but we know that, unfortunately, we did not have a daily uptrend just yet. Moving into resistance, 115 down to 105 is that resistance zone. Big resistance area, guys. It's a very big one from prior, right? Very big one. It's been a very congested area for the bulls, but we also know it's trying to follow what the rest of the market is doing. Weekly higher lows are set. They're going for the trend change attempt. That will be a break above the 90-day tariff pause area, also located at 115. If they do not get it, the bulls have had a decent bounce so far, but nothing to scream home about. If we do pull back a bit lower, guys, there's a couple attempts here. You can have a long attempt if you want to with a stop below the lows right there, or we can continue writing short puts below the 95 to roughly $88 range at around the fear lows. NVIDIA currently still trading at a very attractive valuation in or around a 22 forward multiple. So this one will continue to be front and center on my watch list when looking for either swing trades or selling puts in the market. Moving on to Tesla. Tesla up 3.5% today overall, as they are now up decently from their earnings season. They were able to maintain their quarterly gains, essentially, that they had after the session yesterday, but overall coming into a big area of resistance. Yeah, 260 up to 300 is that very wide range of resistance, guys. It's been plaguing the bulls for a few weeks in a row, actually the last 2 months, but not only then, it's been a very, very hotly contested area a few times throughout Tesla's history overall. I would not be surprised if that area proves to be still challenging. No clearly defined price action. Not yet, right? They're trying to go for an engulfing move. If we pull back from here, looking for higher low, anything above 225, looking for that higher low to maybe start a daily uptrend, and maybe as well get a weekly uptrend going. But the weekly uptrend would start with a break above 291. So there's still a lot of work to be done by the bulls in order to do that. But overall, Tesla earnings were well received. And if we do end the month like this, it's not going to look too bad, right? Coming in very hot into the big two areas, right? And we got finally stopped down there. That was the last stand from the bulls. Maybe looking to get a bit of monthly appreciation on Tesla. It'll probably only go up if the rest of the market goes up, right? If the rest of the market comes down, Tesla's going to go down. Moving on to Palantir right now. Beautiful day by Palantir. 7%. Palantir is just making its ways back to the all-time high, guys. You know, it seems like just yesterday, Palantir was down 40%. almost more than that, almost 50% from the all-time highs at one point, right? And right now it's making good on, right, its promises to deliver returns to investors essentially. Higher lows are set right now, 88.74. Nice daily uptrend. Any pullback looking for a higher low for possible further trend continuation. There is a nice area. Well, I mean, it's this whole area right there, right? You can either put a line, you can put a rectangle if you want. Any pullback into that area, and consequently, these EMAs is going to be looking for a higher low for possible further trend continuation overall. The weekly is looking gorgeous right now. It was a weekly downtrend. Nice, nice, nice engulfing move. Any pullbacks also looking for a weekly higher low for further trend continuation. The valuation right now, I haven't done it since 78 bucks, but you can imagine at 78, if it was expensive, right? Well, it's even more expensive right now. We'll get to hear from them as early as the week of May 5th, essentially 2 weeks time from now, as to how is their business expanding, both government contracts and commercial contracts as well. I think they'll do very well, but well enough to support a valuation at these multiples. We're going to have to see. Moving on to SOFI right now, up 5%. Another good day for SOFI. Another company that is now in the context of a daily uptrend. The higher lows are still planted around 1030 to 1050, this whole region right there. Any move lower from here looking for a higher low for possible further daily uptrend continuation. But we only have a few days before SOFI earnings, which are next Tuesday. So keep that in mind, guys. Next big area of resistance is, of course, $14 up to roughly $16. The top end of that range right there. And also that was the lower end of the range back in the bull market of 2021. SOFI right now looking for a couple other things, right? Weekly downtrend now into weekly uptrend with the higher lows now being set. Weekly uptrend is now officially in motion, looking pretty good. That means that your monthly lows are set, and maybe, just maybe, we've found our monthly higher lows. And in this massive move, are we maybe looking for a bit of monthly trend continuation? We will see. Definitely needs a good broad market and good economic outlook to support that. But we'll get to hear from them next Tuesday per their earnings. We'll get to hear whether this valuation is fair. I think it's fair right now, even at 1242. Not the worst buy, but I would be looking for a pullback here to write some more short puts in around that lower $10 range. Moving on to the before last one, Uber up 5.91, reversing all the losses of yesterday. And we were saying that this one looked pretty, guys. Looked very good, right? Pullback into the support range, all the EMAs. It was looking like a big inverse head and shoulders pattern back to the take profit area. $80 down to 77. You can see best what they're trying to do on the weekly. It was a weekly downtrend. Big engulfing move for Uber right now, looking very good with the higher lows being set. Now going for a bit of weekly trend expansion. So looking all good, everything considered on Uber. The valuation right now at 78 is 10% higher than here. So a 31 forward price to earnings and a 1.1 peg with a very decent free cash flow yield around 4.5%, 5%. Nothing bad to say about the company. Them too have earnings coming up in just 2 short weeks of time. Fantastic company, guys. And the valuation of this one does support some expansion. I would not be surprised if they might be just looking to go into that monthly leg of expansion into the $80 range. Moving on to TSM lastly, TSM, one of the first semis right now to set a new daily uptrend. Their earnings were fantastic. We covered them on the channel just last week, looking very good. So any pullbacks into this resistance, 171 to 156, looking for a higher low for possible trend continuation at that point. Daily uptrend means that weekly is underway as well. So, I mean, it doesn't mean that, but, you know, we've had a series right there. They also set at the same time the weekly higher lows, and now we have consequently a new weekly uptrend. Looking very good. Weekly uptrend means that the monthly lows are now set, and I wasn't screaming at you guys, but I was telling everybody, if you guys like TSM, you know, the lower 140s is probably a good time to nibble for the long-term portfolios. So hopefully you guys are able to acquire a bit of shares. Even if it does pull back further, guys, I don't mind. There's a swing trade opportunity here on a higher low. Stop goes below there, and then you're targeting the other weekly highs of that move right there. So decent R&R for a small scale speculative bet. And for writing put options, same concept, right? Come down there. I will gladly write some short puts in the 140 range once again with this high volatility because the valuation is still very cheap. So that's everything I had for you guys today. Hopefully you enjoyed it. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Also, consider subscribing if you're new. We do these every Monday to Friday. And as always, if you have any questions, please feel free to leave them down below. Lastly, if you did want to join a community of over 150 to almost 200 members that all trade the same strategies right now, well, you might consider joining the trading group for the channel, right? in this trading group, essentially what we do is a ton of different strategies, mostly revolving around credit strategies, the wheel strategy, put credit spreads, small call debit spread trades, but we also take some directional bets too in the form of leap call contracts or building long-term portfolios or just swing trades with shares. I mean, I haven't updated you guys on the portfolio. I was planning to do it tomorrow, but I'm seeing the length of the video right now, and it is quite long. But if you want to see the positions that I closed today, like so many positions were closed at a profit today. More were open in terms of Fiserv, some K-Webs. We also have some lottery plays on Google, Intel, and AbbVie in terms of those. We closed most of these lottery plays at a profit today. And we also have a bunch of call debit spreads open and running, one of which is on Google. So you can see, I mean, we do a lot of the wheel trades as well, but we do have several lottery trades, call debit spreads, some leap trades as well that I've been including as of more recently as the markets have presented us with some fantastic deals overall. So if you guys want access to all of the trades in real time, which I do provide in many various different trading channels, as you can see from the left-hand side right here, there is definitely something for everybody, whether you have a small, medium, or large account. These are all scalable strategies as well. Well, the link is always down below in the video description. We also do private morning live streams where I'm live for about 2-3 hours in the morning, where I trade live and take all your questions on your stocks, your options, your long-term portfolios as well. If you cannot attend, they're always recorded. You can watch them after and or ask me all of your questions in our chat rooms. And I'm very fast to answer everybody all throughout the day. You also get access to our private videos for more advanced level strategies that I don't necessarily show on YouTube. And additionally, access to all of my watch lists, all of them, the options watch list, all the watch lists. You can copy paste them. It's 2 clicks of a button. And anytime you see any technical analysis like support resistance boxes or any annotations on the charts from earnings and or otherwise on over like 100 plus different companies, you just copy paste all my charts. It's an added benefit. If any of that sounds good to you, the link, of course, is once again down below. Hopefully I see you in there soon. And if not, I guess I'll see you back on the channel, guys. Have a good one. See you tomorrow after the close. That's it for me. Have a good rest of your evening and peace.